What if you could unlock a clear path to financial success, no matter how much you earn? Many people think you need a six-figure income to build wealth, but that's not true. The secret is not just about how much money you make. It's about making your money work for you at every stage of your financial journey. Today, we're breaking down the exact financial strategies you need for three common income levels. We'll cover the $40,000, $75,000, and $100,000 plus salary ranges. Stay tuned, because the right advice at the right time can change everything. A common question is what to do with your money as your income grows. The financial advice for someone earning $40,000 a year is very different from the advice for someone earning $100,000. Your priorities shift, your opportunities expand, and your strategies must evolve. In this video, we will walk you through a tailored financial plan for each of these income levels. We'll talk about budgeting, saving, investing, and even how to increase your income. By the end, you'll have a clear roadmap to build wealth, no matter where you're starting from. If you are earning around $40,000 a year, your primary focus is building a solid financial foundation. This is the survival and stability stage. It's all about creating a buffer between you and life's unexpected turns. The most important tool in your arsenal is a budget. A popular and effective method is the 50-30-20 rule. 50% of your after-tax income goes to needs. This includes rent or mortgage, utilities, groceries, and transportation. 30% is for wants. This is where you fit in dining out, hobbies, and entertainment. The final 20% is for savings and debt repayment. This is your ticket to financial progress. Let's break it down. With a $40,000 salary, your after-tax income might be around $32,000, or about $2,667 a month. Following the 50-30-20 rule, you would have $1,333 for needs, $800 for wants, and $533 for savings and debt. It's crucial to be realistic about your housing costs. Ideally, your rent or mortgage should be less than 40% of your net income. This gives you more breathing room in your budget. Your first savings goal is to build an emergency fund. This is a safety net for unexpected expenses like a car repair or a medical bill. Start small. Aim for $1,000 at first. Then, work your way up to 3 to 6 months of living expenses. Automate your savings. Set up an automatic transfer from your checking account to your savings account each payday. Even a small amount, like $25 or $50 a week, adds up over time. An emergency fund is more than just money in the bank. It's freedom from fear. It's the power to handle a crisis without derailing your entire financial life. This newfound security is the true first step toward financial independence. When it comes to debt, focus on high-interest debt first, like credit cards. The minimum payments on your debts are part of your needs category. Any extra payments come from your 20% savings allocation. If your employer offers a 401k retirement plan, contribute at least enough to get the full employer match. It's free money. For example, if your employer matches 50% of your contributions up to 6% of your salary, you should contribute at least 6%. On a $40,000 salary, that's $2,400 a year, or $200 a month. Your employer would add another $1,200. That's a 50% return on your investment instantly. At this income level, increasing your income can have a huge impact. Look for opportunities to develop new skills, earn a certification, or take on a side hustle. Even an extra $200 a month can accelerate your savings and debt repayment goals. The key at the $40,000 level is consistency. It's not about making huge leaps. It's about taking small, steady steps in the right direction. Every dollar you save and invest now is a seed for your future wealth. As your income grows to $75,000 a year, you enter the optimization and growth phase. You have a solid foundation. Now it's time to build on it. Your focus shifts from survival to building serious wealth. You have more disposable income, which means more opportunities to save and invest. But it also means more temptation for lifestyle inflation. This is when your spending increases as your income grows, leaving you with little to show for your bigger paycheck. The key is to control lifestyle inflation and put your extra income to work. For instance, getting a $10,000 raise doesn't mean you suddenly have an extra $800 a month for bigger car payments. A smart approach is to allocate at least half of that raise directly to your savings and investment goals. This way, you still enjoy some of your hard-earned money while accelerating your path to wealth. Think of it as paying your future self first. Let's look at the numbers. A $75,000 salary might give you an after-tax income of around $56,000, or about $4,667 a month. Using the 50-30-20 rule, you would have $2,333 for needs, $1,400 for wants, and $933 for savings and debt. You might also consider a variation like the 60-25-15 rule, where 60% goes to needs, 25% to wants, and 15% to savings. The best budget is the one you can stick to. The important thing is to be intentional with your money. At this stage, you should aim to maximize your retirement contributions. If you have a 401k, try to contribute more than just the employer match. Aim for 10 to 15% of your pre-tax income. On a $75,000 salary, 15% is $11,250 a year. That's a significant step towards a secure retirement. You should also consider opening a Roth IRA. A Roth IRA is a retirement account where you contribute after-tax dollars. Your money grows tax-free, and you can withdraw it tax-free in retirement. In 2025, you can contribute up to $7,000 a year to a Roth IRA. If you are 50 or older, you can contribute an extra $1,000. With your retirement savings on track, it's time to start investing outside of retirement accounts. Open a taxable brokerage account. This is an investment account with no special tax benefits, but also no restrictions on when you can withdraw your money. You can invest in a mix of low-cost index funds and exchange-traded funds. When considering index funds, look for broad market options like those tracking the S&P 500 or a total stock market index. These provide instant diversification. This is a great way to build wealth for medium-term goals, like a down payment on a house, or for long-term goals beyond retirement. Risk management also becomes more important at this income level. Review your insurance coverage. Do you have enough life insurance to protect your family? Do you have disability insurance to protect your income if you get sick or injured and cannot work? Many employers offer affordable group disability insurance. It's a small price to pay for peace of mind. You should also have a fully funded emergency fund of 3 to 6 months of living expenses. With a higher income and potentially more financial responsibilities, a larger emergency fund is a wise move. Finally, get serious about paying off debt. With more disposable income, you can make extra payments on student loans, car loans, and your mortgage. Paying off a 5% car loan is like getting a guaranteed 5% return on your money. It also frees up your cash flow for other goals. At the $75,000 level, you're moving from defense to offense. You are not just protecting yourself from financial shocks. You are actively building a more prosperous future. When your income crosses the $100,000 mark, you enter a new phase of your financial journey. The focus shifts from simply saving and investing to strategic wealth building and tax optimization. At this level, the more you earn, the more you pay in taxes. So it's crucial to use every available strategy to minimize your tax burden and maximize your wealth. Your top priority is to max out all of your tax-advantaged retirement accounts. For your 401k, the contribution limit in 2025 is $23,500. If you are 50 or older, you can contribute an additional $7,500. That's a total of $31,000. You should also max out your health savings account if you have a high-deductible health plan. An HSA is a triple tax-advantaged account. Your contributions are tax-deductible, your money grows tax-deferred, and your withdrawals are tax-free for qualified medical expenses. In 2025, you can contribute up to $4,300 for an individual or $8,550 for a family. If your income is too high to contribute directly to a Roth IRA, you can use a strategy called the backdoor Roth IRA. This involves contributing to a traditional IRA, which has no income limits, and then immediately converting it to a Roth IRA. This allows you to get money into a Roth IRA regardless of your income. Some employer plans also offer a mega backdoor Roth option. This allows you to make after-tax contributions to your 401k and then convert them to a Roth IRA. This is a powerful way to get a large amount of money into a tax-free retirement account. With your retirement accounts maxed out, you can focus on your taxable brokerage account. This is where you can build significant wealth. But you need to be smart about taxes. One important strategy is tax loss harvesting. This involves selling investments that have lost value to offset the capital gains from your winning investments. You can also deduct up to $3,000 in net losses against your regular income each year. Another strategy is asset location. This means placing your least tax-efficient investments, like corporate bonds, in your tax-advantaged retirement accounts, and your most tax-efficient investments, like index funds, in your taxable brokerage account. This simple act of organization can save you thousands in taxes over the long run by reducing what is known as tax drag on your portfolio's growth. Charitable giving can also be a powerful tax-saving tool. You can donate appreciated stocks directly to a charity. This allows you to avoid paying capital gains taxes on the appreciation. You can also set up a donor-advised fund. This is like a personal charitable savings account. You contribute to the fund, get an immediate tax deduction, and then recommend grants to your favorite charities over time. If you're over 70 and a half, you can make a qualified charitable distribution from your IRA. This allows you to donate up to $100,000 directly to a charity, and the distribution is not included in your taxable income. At the $100,000 plus level, it's also wise to consider working with a financial advisor and a tax professional. They can help you navigate the complexities of your financial situation and create a comprehensive plan that covers everything from investing and tax planning to estate planning and insurance. At this income level, you have the potential to build substantial and lasting wealth. It's not just about making money. It's about making your money make more money. As you can see, your financial strategy shouldn't be one size fits all. It needs to adapt and grow with you. At $40,000, you are building your foundation. You're focused on budgeting, saving, and getting out of debt. At $75,000, you are optimizing your finances. You're increasing your investments, managing risk, and controlling lifestyle inflation. And at $100,000 and beyond, you are in the wealth building and tax optimization phase. You're using advanced strategies to grow your wealth and minimize your taxes. No matter what your income is, the principles of financial success are the same. Live below your means, save and invest consistently, and never stop learning. With the right plan and the right mindset, you can achieve your goals. What's your biggest financial question right now? Let us know in the comments below. And if you found this video helpful, be sure to like, subscribe, and hit the notification bell for more financial wisdom from Frankie Finance.